end of August this year. Now, all the offices that we have globally are really from a sales or a support perspective. So my team around the world will sit down with investors in each of these locations to talk through, why the UK, why Manchester, why Birmingham, as an example. Whereas the London office is more centered around the main operational roles and functions of the business. So there we've got a great team on the ground, a team of 10 that specialize in all the research and due diligence side of things. So it's essentially their job to go and find the next best opportunity in the UK. And they look at all sorts of macroeconomic fundamentals, such as corporate behaviours, so where a company's relocating to, infrastructure spends, transport regeneration development, retention rates of graduates from higher education, all sorts of things. And that's not to say because we don't invest in Southampton, as an example, let's go and look at Southampton. It could be where within Manchester or where within Birmingham, where we do a lot of developments, where's the next upcoming area or growth corridor that our investors are going to see real and true value for money. Now, once we've actually identified the area, we then go about sourcing the projects. Now, there's only a handful of developers that we work with. There's about 6 developers that we work with, and they're the best of the best in their respective regions, from the northwest all the way down to the southeast coast. And we've got different deal structures. We can essentially act as the master agent. So developer X won't have a sales team. They will employ us to distribute their development globally. We can do underwrite models where we invest our own capital alongside the investors, which is typically the model that we'll go down. We've then got what's called a joint venture. So we will buy the land, the developer would take on the debt to then build. And the fourth structure is we are the developer. So we've got our own developer arm called City House. We're completing our first project Q1 of next year. And we've got another 3 projects in Manchester and Birmingham that we'll be launching later this year as well. Point 3 is then the investment advice. So that's where my team around the world, so James as an example, would bring the product to market. He would sit down with Toni and his team and with you as an investor to talk through why we've picked this development in Birmingham, sort of the macroeconomic fundamentals around that, supply, demand imbalances, so on and so forth. Now, for me, I've been in financial services and offshore investments for the last 12, 13 years, 10 of which have been based in the Middle East. And for me, everything that I want to do and want the team to do is all about service. It's okay having the best product, but unless you can service that post-sale, it's no good. So point 4 to 8 is all about the back office support network that we have. Like I said, we want to make it hands-off, hassle-free, not only for you guys as investors, but also for my team internally. So once you've agreed to go ahead with unit 1, 2, 3 in Birmingham, as an example, we've then got a team of 7 based between London and Dubai. So we meet all time zones. That'll then hold your hand through every step of the process. That can be introducing you to the conveyancing team that will opt on your behalf, that we've handpicked to represent you. Getting marketing updates. So we send quarterly construction updates from a marketing perspective. So if you've purchased an off-plan development, as an example, you can see how the build is progressing over that 12, 18 or 24 months. That way you get a real feel of my money's actually working for me. We provide monthly newsletters in form of market updates. So interest rates at the moment, inflation at the moment, where we believe are the next hotspots, what's driving the supply demand imbalance, so on and so forth, just to keep investors abreast as to how the UK market is performing. Point 7 is the mortgage support team. Now, these aren't CMAP, so they're not giving the mortgage advice, but what they do is very similar to point 4, the sales progression, is they will hold your hand as the investor through the whole mortgage process. So we've got a panel of mortgage brokers that we would use that have up to about 80 different lenders available on their panel. Really, again, to make it hands-off, hassle-free, they're there to find the best mortgage product suitable to your individual needs and requirements. Okay. Completions team work hand in hand with the mortgage team to ensure that once the mortgage is approved in place, we can complete in a timely manner. And then for me, point 9 and 10 are hugely important. There's no point buying a property and holding it as an asset unless you can find a tenant and rent it out. Now, being based in South Africa, being based in Asia, being based in Europe, wherever it may be, the last thing you want to be dealing with is trying to find a tenant being thousands of miles away, dealing with water leaks, deal with a window being broken as an example, okay? So we've got a full management arm in place called Redstone Property Management, who are part of the API group of companies. And they will do the full 360 service for you, from sourcing the tenant, doing the background checks and referencing of the tenant, making sure the bills are paid, making sure the council taxes are up to date, all the way through to that maintenance element. So if there is a leak in the bathroom, you're not getting a phone call late of an evening or the weekend asking for help. Redstone will act as that point of contact, regardless of where you are in the world or regardless of how many properties you have. And then point 10 for me is the most exciting part: portfolio optimization. So essentially, globally at the moment in the world, everything is all about AI, machine learning, how you can enhance the customer experience. So what we're building, or what we've built now, which will come into fruition at the end of this month, is a platform. And on that platform, it will show, Toni, in 2018, you bought a property for £200,000. Your mortgage was £150,000. The interest rate you had at the time was 5%, and your rental income was £1,000 a month. Fast forward to 5 years later, what does that now look like? Well, the property's grown to £300,000. Your rent has increased to £1,400, and the 5-year fixed rate mortgage product you're on is coming up for renewal. So what are your options? Okay, how do we review that? Well, point one is you can sell the asset, crystallize the gain, move on and invest into something else. Point two would be remortgage. So can we get you onto a mortgage product that's, let's say, 4%? So your outgoings are less, your net income is then higher. That will increase your ROI. Or the final point is equity release. So in the UK, you can, any growth that you've made in the property, you can typically strip out 70% of that. So if that property is grown by £100,000 in value, we can release £70,000 of that you can then utilize to use as a deposit on another property without utilizing any additional funds from your bank account. And really, that's how we help build and grow investors to get multiple unit portfolios, really using the cash that I invested 3, 4, 5 years earlier. Okay, so between the sort of steps 1 to 10, we truly do offer that hands-off, hassle-free service, really to make it an emotionless purchase. It's buying property is a big commitment, okay, especially if it's your family home. You want to make sure the view's great, the road you're on is the road you want to be on, it's safe, so on and so forth. From an investor perspective, I think it's important that we remove all emotion out of the equation. You're not going to live there. Forget that property is the actual asset class. That's just the asset that sits within a vehicle that's generating you, one, capital growth, but also secondly, the income element. Okay, and we look purely at the numbers. So just to give you a bit of an update as to the market, how the UK market performed in the month of May. The June's figures haven't yet come out yet. Typically, we focused on the Northwest, the Midlands and London. And today we're going to cover the Northwest and the Midlands in our developments. But in May, Northwest as a region increased by 1.5%, Midlands 1.2%, West Midlands and East Midlands 0.5%. So yes, at the moment you will see, not just in the UK, but I think globally, a lot of scaremongering in the press, in the media, the world's coming to an end, so on and so forth. If we look at the basic fundamentals of supply and demand, okay, not just in property, but economics, more people trying to buy than sell or trying to rent than what's available, prices will grow. And in the UK, you've got a huge undersupply of property. There's a huge crisis. COVID's a great example. Developers and contractors could not get on site. Supply stopped completely, yet the demand constantly increased and grew. And at the moment, it's continuing. Yes, interest rates around the world have risen. That's not just affected the retail buyer. It's also affected the developers that are taking on the senior and the mezzanine debt. Their margins have reduced, which means sometimes it's not viable for them to actually build that 100-unit development. So they'll wait, per se. But the demand constantly increases, okay? Now, over the last 40 years, the UK Housing Association had targets to bring 300,000 new properties to market every year to try and meet the demand supply imbalance. That's now just been scrapped because we're now 40 years on and the targets have never been hit. So suppose why have a target if it's not achievable? The highest they ever achieved was 250,000, which was late 80s, early 90s. But since then, the deficit has grown and grown and grown. So that's now been scrapped. And again, why supply so short? The UK is an island. There's only so much land that you can actually build on. In particular, the areas that we want to focus on, really city centres or cusp of city centres, there's not that much land remaining where people can build. So supply really is getting squeezed and squeezed and squeezed. Yet the appeal these big cities and economies have, the demand is outgrowing and outperforming supply coming to market. And again, any asset class where you've got more people trying to buy than sell or needing to rent than what's available naturally drives growth. Now, for me, this solidifies why UK property in particular continues to defy all odds. That's why it's been the go-to asset class, in particular over the last 12 to 15 months. You know, I think if we look back at end of Jan, early Feb 2022, and you had the Russia-Ukraine conflict as an example. And what we've seen globally was most asset classes, they did this. Crypto market crashed, the equity market crashed, the stock market crashed. Okay? And the rationale behind that is, in times of uncertainty, people will typically sell liquid assets because they want to sit on cash because they don't know what opportunities may arise or what is going to happen around the corner. Okay? More people selling than buying, prices go down, how economics work. Property is an illiquid asset. So you can't just go and sell your bedroom, your bathroom, or your kitchen. Okay? Now, typically, people aren't going to sell their properties because there's a conflict going on in Europe. So that means if people aren't selling, you've got a natural demand barrier. Then when you coupon all the other demand factors coming in from the graduate retention rates in the major cities, from the infrastructure that's been implemented to allow transport from point A to point B more attractive and appealing, from companies relocating to areas, that's adding a higher demand factor on. That's why we've seen the prices increase. Now, granted, you can see on the screen here, you had a dip October, November, December, which was really down to political instability when we had Liz Truss and her right-hand man, Kwasi, come in and give a budget announcement in the UK, which was just wrong timing. Was it the right thing for the UK? Probably, but was it the right time? Absolutely not. The market didn't react well, and with that, we've seen a decrease in prices. However, from the start of this year, January up until May, and you will continue to see it in June, the average price across the UK has continued to increase, which is what we're looking for because there's just not enough supply coming to market. So again, over the last 12 months, prices of property have grown. Typically, other asset classes have decreased. Now, for us, what we've seen globally across our offices, and I've done quite a lot of traveling over the last 7 to 8 weeks from South America to Asia and back to the Middle East. There's really 3 key things that investors want to understand. What's my lettings and management situation? Do I have to do it myself? No, Reds don't do it for you. Can I get a mortgage as a non-UK resident or non-UK national? Yes. We have got lenders that have mortgage brokers that have over 80 lenders available that specialize in overseas expatriate mortgages, non-UK national, non-UK resident. And the final one is your tax position. What tax do I have to pay investing into a country where I'm not a resident or a national of? So on the final point of tax element, there's no right or wrong answer. It depends on the individuals and the investors' circumstances and current exposure or liabilities to the UK. That being said, we have a structure in place whereby if you are liable for tax, we can mitigate that and make it a tax-efficient solution, which essentially enhances your overall return on investment. So just to give you an example, in the UK, depending on where you're resident or national of, you get what's called tax relief, a UK personal allowance, which at the moment is £12,570. That means the first £12,570 you earn is tax-free. Some nationalities or some countries that people may reside in don't get that allowance, so they pay tax on the first penny they earn. If that is the case, then we can set up what's called a limited company. So rather than holding it in a personal name, you hold it through a company structure where you then pay corporation tax. Now, when you pay corporation tax, you've got a lot of deductibles that you can offset to actually minimize the mortgage payment, the interest payments that you're going to pay, the tax payments you're going to pay. So it's rather than paying 20% income tax, you pay 19% corporation tax, of which you deduct your service charge, your management charge, the interest component of your mortgage. So actually having a higher interest rates at the moment benefits from a tax perspective. Any maintenance charges you can also deduct as well. Okay. Also, then when you sell the asset, we can reduce your capital gains liability. So like I said, there's no right or wrong answer. That's something that we would evaluate when sitting down with yourself to see whether it's beneficial or not. But I just want to make sure everyone knows there are solutions in place where we can really make tax as little as possible and drive your overall ROI. Now, for us, it's all about how we can help clients get mortgages. Okay, again, we focus on the return on investment. What's giving you the best return on capital? If you've put down X, how do we get you to Y? Now, there's some people that may think, I don't want to take a mortgage because debt is bad. No one needs debt in their life. Okay, credit card debt is bad. Mortgage finance debt is a great debt to have because it allows you to leverage. Okay, now when you have the ability to leverage, the returns are based on the higher amount, not the capital you've invested. And let me explain why. So if you buy a £300,000 property outright in cash, no mortgage, and that grows by £50,000 over a 5-year period, then as a return on investment, that's 16.66%. Okay, £300,000 in, grown by £50,000, 50 by 300 is 16.66%. That's a return of around 3.33% per annum. For me, that's not that attractive. Okay. However, that same property, if you only put £100,000 down as a deposit and you borrow £200,000 from the bank, whether you own it outright or you have a mortgage, the property still grows by the same amount. Okay, there is no impact whatsoever. So again, if it grows by £50,000, and as a return on your investment, that's 50%, because you've only put £100,000 in and you've made £50,000 back. Then when we bring into account rental income, you know, we can be targeting anywhere from 12 to 14% per annum. For me, that is exciting, especially when we go into a low risk asset that you can touch it, you can feel it, you can see it. Okay. So for us, it's all about how we enable investors to get a mortgage. And again, that comes down to the due diligence that we conduct. We will never take on a product or bring a development to market whereby it's not mortgageable. Okay. Because for us, it's all about we enhance the return on investment, getting investors put down as little as possible so you can maximize your returns on the higher amount. Now, what I'm going to do, I'm going to pass over to James now, who will just run through a couple examples of what we have at the moment. This is our development that completes in the next 3 weeks. So like I said, we've got a completed option now, a development in 12 months time at a lower price point, and a development in 12 months time at a slightly higher price point.
Brilliant. Thanks, Lewis. I'll get straight into it. So as mentioned, this is our Birmingham project, very, very near completion now, looking great. It's just to the east part of the city core of Birmingham, consists of 1 beds, 2 beds and 2-bed duplexes. So developer here was the Tenant Group Limited, as mentioned, B12 postcode there. It consists of 70 units in total, a 250-year leasehold. Now the service charge here is a very reasonable £1.57. That obviously includes insurances, warranties, the upkeep of communal space, the gym, there's a roof terrace there, there's parking, so that's all included within that. We have a conservative prediction here on the yield of 5%. There's a 10-year building warranty available there as well. As Lewis mentioned, we have the property management team Redstone on hand to assist. They can provide furniture packs where necessary as well. And we're from a starting price point here of $225,000 for the 1 beds. So as Lewis mentioned, we're largely a research-led company. You know, a huge amount of time and effort is spent on identifying the key areas we're going to focus on for our projects, for our investments. So I just want to take a step back and look at Birmingham in general and why we chose this specific location. So the city has a population of 1.2 million. It is rapidly growing. Between 2002 and 2015, saw a growth of 163%, which is the second fastest to London in terms of growing population. A large percentage of that is very young, dynamic, affluent demographic, so 37% of which are under the age of 35, which is great for the growth of the city and the ongoing progress of the economy. It sits in the top 3 of UK destinations for foreign direct investment, so it's very well identified across the world. It's been the benefactor of multiple investment cases from abroad. It does sit on as the UK's second city behind London on nearly all points. As mentioned, population is constantly growing. Trajectory isn't changing. We're seeing roughly 10,000 individuals adding to that population year in, year out, which is obviously further contributing to the demand for property in Birmingham. As I touched on already, there's a very young population there. It actually is the youngest city in Europe. A large percentage of that is down to the student retention rate. So it's 41% of the graduates remain in Birmingham after completing their studies. There's an 80,000 strong student population in Birmingham. So it's a huge influx in personnel looking for somewhere to live, whether that be to buy or to rent. Now, given the age, early 20s, there's a huge percentage of people who really are only going to be focusing on rental properties. Very few can afford to buy at that point. So again, contributing to the local demand straight out of university. They're the young professionals, well-educated, well-trained, staying within the city and driving the economy forward. Now, a big part of that really, I suppose... Sorry,
just on that, James, just on that, I think it's a great point to note about, people having to rent. I talked about a supply shortfall in the UK at the moment, but you've also got what's called a cost of living crisis, in that people are having to rent for longer because inflation's gone up in the UK and the cost of goods, so on and so forth, has increased. And, I've got friends in the UK that moan, a pack of Lurpak is now £12. Petrol prices are this. Their heating and water bills are that. And there was a great article that came out in the Financial Times about 2021, end of 2021, which said a family of four, husband and wife, both working, 2 kids. And it took them an average 5 years to save up a 20% deposit to go and put down on a property themselves. Okay? When you factor in all their outgoings like tax, national insurance, car finance, credit card, whatever it may be. If you include London, that was 7 years. Fast forward to today, it's now doubled. It's now gone to 10 years for regional cities. If you include London, it's 15 years. And from an investor perspective, it's unbelievable to hear, because that you've essentially got a guaranteed income coming in. And I'll give you an example. If James is my tenant and I'm charging him £1,000 a month in a 1-bed, and 3 months before expiration of the tenancy contract, I say, right, James, when you renew, it's going to be £1,100. If he was to say no, then I know it's not an issue, because Tony's going to come in and bite my hand off, because there's just not enough property coming to market. So these guys have to rent for longer. So again, from an investor perspective, the UK rental market is so hot, and the fundamentals that are driving the growth aren't going away anytime soon.
And I think another point on that, guys, I think with exactly what you were saying there, Lewis, is with the cost of living, electricity, food, all those levels, you find that there's a lot of people that also downscale, that couldn't afford the bigger house. They want more lock up and go. They need more. Newer developments are more green friendly because the technology that's been used in the development. So I think that also has driven the affordable market where. And it's a question to both of you. Do you find that there's lower risk in the more affordable market because there's more people that will rent it, number one? And number two, if you want to sell it more, there's more people in that pot that are, instead of having a property at like 600 or 800 or £1 million, there's more people in this affordable segment of the market. Do you guys find that as well?
Yeah, so if I look at, over the last 10 years, our stock has always been between sort of typically 200 to the 500,000 price point, the retail figure. Granted, one of the developments today we're going to show it starts at a lower price, but it's with a developer that we're for a long number of time. But yeah, absolutely, Tony. We don't want to be selling 700, 800, 900, £1 million houses, because as an investor, it doesn't make sense. We look at numbers.
Yeah, exactly.
And us, like you said, you'll always have a market for the retail stock, the retail investor, whatever it may be, that £200,000 to £500,000 price point. Because regardless of what happens in the UK, whether you're in a recession or not, people still need somewhere to live. And that's what we class as affordable housing.
Yeah. Perfect. Thank you.
Yeah. I think I read as well recently that the average first-time buyer now is 35, and that age is continuously going up and up and up. And obviously, if you're not buying, you're going to have to rent somewhere. So it's an ongoing gap in terms of supply and demand. Right, we have here the 20-year master plan. So in Birmingham, this multi-billion-pound plan was put in place. And what we see on the right here on the map is the city core. In essence, the plan was to see the city core grow and expand. Now, the real benefit here with the property is obviously if we acquire any property or development just outside the city core in the red, and then we see the city centre swell and expand, what was once outside city centre prices will then soon become city centre value, which is really what we try to focus on in terms of the pockets of value. And now the development here, Apex Lofts, sits within that projected city core, which is exactly where we want to be. Now, the 20-year master plan consists of some major developments, major investment projects. The Smithfield master plan for one, it's 170,000 square foot of new retail, leisure, office space, creating 3,000 new jobs. We've got the south side and Digby regeneration zones. So you can see there's six zones around the map there. Digbeth and south side down to the right. That's £1.5 billion of investment, catering for 50,000 jobs. Really importantly, HS2 Curzon Street. So that's up in the sort of the right hand side there, which is set to revolutionise transport and connectivity within the UK, creating a direct route between London and Birmingham, travel time of 49 minutes, which is nothing. So it's off the back of that huge amount of investment and interest in Birmingham. We're going to see employees, executives working in London on a London salary, able to commute in and out of London from Birmingham. They're on this income in a city in Birmingham where the cost of living is significantly lower than London, able to then spend locally, afford expensive property, push the economy forward there. Also got Paradise.
And I think just on that, James, sorry to interject, just on that, I think you made some great points there about the jobs that are being created. Now, we can argue that in a big city like Birmingham, if you've got tens of thousands of new jobs being created, do they currently have enough skilled workers or individuals within that area to fill those vacancies? The answer is no, which means they have to recruit from outside of the city and bring them in. So again, the more people we've got coming into a city or an area, that creates a demand. Now, if that supply can't keep up, then you will constantly see those prices grow.
Yeah, absolutely. And that sort of ties in with the last point. Paradise Chamberlain Square is the big sort of financial hub where major companies like Goldman Sachs, HSBC, Deutsche Bank have recently relocated. They moved their offices there, or they've set up new offices there, and they're employing locally, nationally, internationally. They're having to move their workforce to there, and obviously that brings in a huge number of people. Again, they need to buy or rent, and it further fuels the demand for the property in these city centre locations. So there's a brilliant slide here. So it gives you an idea of the numbers in terms of growth of what we've seen and moving forward. So October 2022 to October 2021, we saw growth there, 14.5% West Midlands, 16% Northwest, 15% Yorkshire and Humber, South East 11, and London 6. So obviously sitting very nicely there at 14.5%. But if you look over the last 5 years, it's a very, very impressive trajectory, 36.97% growth in property value in Birmingham, which is amazing. And it's continuing in that vein. The next 4 years up to 2027, we're expecting to see another 19.3% growth of rental value and capital appreciation, 19.2%. So you've got fantastic growth there on both aspects. This is all research done by us as well as the likes of JLL, Savills. It's all in line. So it's looking really, really positive.
Just on that, you go first, Lewis. You go first.
I think just on that, I spoke about the power of leverage before and the ability to mortgage your property. Typically, it'd be 30% deposit, 70% mortgage. So if you look back at the last 5 years' growth, if you put 30% down, you've more than doubled your money over a 5-year period just from capital appreciation, because the property value has grown by 36%, but you've only put down 30% capital. So when you then add rental income into that factor, the returns are huge. And again, for me, when you can get double-digit returns in a low-risk asset class, where you can touch it, you can feel it, you can see it, it just makes it a compelling investment case.
Absolutely. And I think the other part of it, and I say this to my team in South Africa and Cape Town and clients as well that I'm dealing on a daily basis is like, when is the time, when is the right time? If you take capital growth of 19.3%, and if you look at the rand and what the rand has done to the pound over the last like 5 years, just take the last 2 years. And, you know, I'm passionately South African, still love South Africa, got my team in Cape Town and in South Africa. And Lewis, you started, it's not an emotional decision. It's about going, diversifying your portfolio, sell one or two of your properties in South Africa, put that into UK property. If you're getting 19.3% plus you taking the loss on the rand, and the rand's lost 30%. So you're getting 19% plus your 30%, you're sitting at 40%. Where do you get those sort of, and you've got a diversified portfolio, and you're sitting with one of the strongest currencies on the globe. It's about diversifying and understanding that leverage is compounded to another level if you just take the hedge against the rand. It makes it really, really exciting.
Yeah, no, absolutely.
So just a visual here on how close we sit to the city core. So at the bottom you can see Apex Lofts there. We can see the city core just above it. I mean, the bullring there, it accounts for a fifth of Birmingham's retail. You've got the major employment hubs. You can see the Smithfield master site that I mentioned before. It's all moments away. We've got HS2 Curzon Street Station on the right there. So that's a 4-minute drive. As I said, that will link London within 45 minutes. So it's a prime location. It's all very, very handy.
And I think just, you know, when we look at developments and the research that we conduct, typically we don't want to be right in the middle of the city centre, because again, from an investment perspective, you pay a higher price per square foot and the yields don't always correlate. If we do find city centre developments, they're very well priced developments where we've sort of gone in undervalued, but typically we'll be on the cusp of city centre. So like James mentioned earlier, the edge of the core, because as the more investment comes into the city, the more demand that kicks in, those zone 2 prices naturally become zone 1 as the city centre expands. So if we can get in below city centre prices, the upward trajectory from a growth perspective is just that little bit more.
Brilliant. And just a couple of visuals here, guys. So the top 2 photos are the completed units. As you can see, lovely and bright, nice and spacious. I mean, the one beds are over 550 square foot. They're really well sized. And then we've got the communal space, the roof terrace, the outdoor gymnasium. You know, it's been designed with tenants in mind. It's got rooftop skyline views of Birmingham. It's a really nice setup. It's very well created. Brilliant. So that was first project in Birmingham. Looking onto our second here is the Silk Yard in Derby. So if you were to take a half an hour train to the northeast of Birmingham, this is where we're based here. And as you can see, there's a visual there of what it will look like. Really nice floor to ceiling windows, nice and bright. It's got the green space around as well. So it's going to look fantastic. So as Lewis mentioned before, this is an off-plan project. It's well underway and it's completing Q2 next year. The developer here is Elevate Property Group. It's actually our 9th project we've done with them now. They've got a faultless track record, always delivered very, very high quality, and always on time, which is you know, gives a lot of credit to them. So the total development, it includes 258 units. We're just available with phase 1 at the moment. We're looking at 250-year lease length. There's £2 per square foot service charge, so very reasonable again. We have a conservative expected yield of 5.25%. As we know, the rental market is red hot and continues to grow, so very much expect that to continue in the right direction. There's a 10-year building warranty, and again, we've got the furniture packs available we can sort out, and we have the parking spaces with this development as well. And a massive point here is the entry point. So from £139,000, you're into the UK property market. So it's a lovely project to start with.
And I just think just on that, so because this one is off plan, the payment plan's structured slightly differently. So Apex, whereas it's completed now, you'd go straight to mortgage. So you don't actually pay anything until the mortgage is approved and in place, bar the initial reservation fee. Whereas with an off-plan development, you pay 20% down now, That allows you to exchange on contracts, and then on completion, you pay the remaining 80%, of which you would typically mortgage 70% again. So just to give you an example, for £139,000 studio, including legals, you're down for about £30,000 initially. Okay, so price point wise, it's very accessible for sort of all levels of investors, but certainly someone who wants to dip their toe in the market, maybe a first property, here's a superb price point to really do that with.
So again, we're going to look at Derby and why we focused here, and we have our development here in Derby. So industry really is thriving. I mean, as a location, it's very central to the UK. I mean, 80% of the population are within a 4-hour drive, so it's got great reach in that sense. You've got major motorways running past. You've got 5 airports surrounding Derby. East Midlands Airport is the closest, flies to 90 destinations internationally. It's 50 miles away. It's also home to the largest rail cluster in Europe. National Rail have just established their headquarters here, or are starting to do so. So there's a huge amount going on. You've got major engineering and industrial companies such as Alstom, Rolls-Royce, Toyota, all with deep roots set in Derby. Rolls-Royce have a workforce of over 12,000 here. They've just invested another 500 million in their sites. And obviously these companies, they're employing skilled, very capable staff. And off the back of that, the earnings in Derby are considerably higher than average. We're looking at an average income here of 41,000 compared to the rest of the UK, which is at 33,000. Obviously you've got here people earning good money, but there's a real shortage of decent property for them to live in reasonable commuting distance of their work as well. So there's a real opportunity from an investment point of view. Goes hand in hand, but the economy is also thriving. We're in the midst of a £3.5 billion regeneration scheme in Derby, which is ongoing. I mean, the city itself sees 250,000 visitors a year, and that's going to continue to grow with the increased attractions on offer. There's already a £12 million iHub Innovation Centre which has been completed. It's home to Airbus, Composite Braiding, VRCO, so big companies as well. By the end of the year, we're expecting to see an economy value of £7.1 billion. And I've also already mentioned about the income there available to employees. It's the highest graduate salary outside of London, which is remarkable, and it really is a telltale sign of the opportunities available in Derby. And off the back of that, we're expecting to see a further 10,000 jobs become available between now and 2030, 4,500 being made available the last 3 years. So it really is a city on the up. It's very exciting to see where it'll get to.
I think just on that as well, you know, I was very surprised about the graduate perspective being the second highest paid city in the UK. And it's when you actually dive into the investment case and understand the rationale why. The likes of Rolls-Royce, Toyota, Bombardier, huge companies, not just in the UK, but from a global perspective. The aviation and automobile industry, they're highly skilled, highly paid jobs. So it's not surprising when you can see the graduate salary outside of London is the highest in the UK. Like James said, the quality of developments in Derby city centre on the cusp of are nowhere near to the standard and the spec that the Silk Yard can offer. So if we're targeting a higher paid individual in the rest of the UK, they want to go into the nicer areas or the nicer developments within that city. So again, it's how we can keep the tenants for a longer period of time. Well, easy way to answer that is bring them a development which makes them want to stay there for a longer period of time. That is ultra high spec and ultra high quality.
Exactly. Brilliant. And just put on the numbers and the projected growth. So we saw 8% rental growth 2020 to 2021, which was the highest in the UK. There was double-digit growth on the rental side last year as well. And looking forward over the next 5 years, 17.5% further capital appreciation for property values. So in a great place, and trajectory is looking really, really positive there. It's always handy to have a map. So this just gives you an idea of where we're where we're sitting in relation to the city. So you can see there's the station sign there, and just to the sort of northwest of there, you've got the Silk Yard. So it's 4 minutes away. It's very, very close. So really well located. You've also got the natural city centre within the A601 ring road there. There's a major shopping centre just at the top of the road, the Derbian. It consists of major companies like Marks and Spencer's, Debenhams. It's full of restaurants and bars. It is right on your doorstep there as well. And the big employment hubs that we've already touched on, Toyota, Bombardier, Rolls-Royce, they're all to the south within a short commute distance there. So it's really nicely located. You've got the River Derwent running through the city. There's a park just to the right of the railway as well. So again, we're right on the cusp of the city centre in a prime location.
Okay, thank you for that, James. And then
Thanks,
just to give you, again, an example of another development, again, very similar to Derby, and it completes in 12 months' time, however, slightly of a higher price point. So this one's in Manchester. So we've done Birmingham, Derby, now we're northwest in Manchester. So Victoria House, developer on this is Salboy. So for me, one of the best developers, if not the best developer in Manchester. They've delivered on thousands of units. We've worked with them for now the last 8 or 9 years. So from a developer perspective, you can't really get much better, certainly in Manchester. Now, again, when we talk about the fundamentals that we focus on from a research perspective, obviously one of the big drivers that we spoke about over the last 2 developments is corporate behaviours. Where are companies relocating to? Great stat on the screen. Since 2014, you've had a 58% increase in companies that are now relocating to Manchester. Okay, really is the northern powerhouse of the UK. You've now got just under 24,000 new companies that are based there. Now, for me, this really solidifies where Manchester sticks out from an industry perspective. On the left-hand side, you can see a graph or a table. Orange is sort of Great Britain, and the white line is Manchester. If you look at the bottom and you look at the financial or scientific or professional industries, you can see the percentage of Manchester employment that's based within those certain industries or specialized industries, which is significantly higher than the rest of the UK. So when we're focusing on the media, the tech, the financial districts, your Deloitte, your EYs, your HSBCs, these are really the powerhouses behind the Manchester economy and what's driving that growth from the individuals that it's attracting. We talk about regeneration, we talk about investment into the city, new infrastructure and transport links that are coming about as an example. Here you can see 4 different regeneration schemes that are happening throughout Manchester and the city centre. For me, the most important stat on the screen is the one in the bottom left-hand corner. 8.7 million square feet of new commercial space, office space, retail space, leisure space. That's creating 45,000 new jobs. So very similar to what James mentioned earlier about the Birmingham investment case and the new jobs that have been created there. Manchester is the exact same. The fundamentals remain the same throughout. More jobs being created. It's an attraction and appeal to bring people from out of the city into the city. And again, they need somewhere to live, whether they're buying or renting. That creates a demand in that local economy. From a transport perspective, Manchester Airport's undergoing a huge expansion at the moment, which is due to complete next year. That alone will create 1,500 new jobs, both directly and indirectly as well. Obviously, the HS2, which James touched on, the Birmingham investment case, which links you from London into city centre in under 50 minutes. That will then go to Manchester as well. You'll be there to London under an hour 11 minutes, which is roughly nearly half the commuter time at the moment. Across the UK, the HS2 is creating 55,000 new jobs, of which a lot of those are based in Manchester and Birmingham as well. But for me, the ease of commuting to and from Manchester is probably the best connected city in the UK, in my opinion. The Metro line, you've got 7 different lines, 93 stops, services 40 million passengers every year. Okay, I was in Manchester at Christmas and commuting to and from various parts of the city. It's so accessible. No one really drives in and around the city centre. Like most city centres, you can commute to and from different locations quite easily to make it really accessible and appealing from a work and location perspective. Just to give you a bit of background information, again, looking at the last 5 years, not as much as not as much as Birmingham, but still an unbelievable investment case, just under 21% capital appreciation across the board. However, if we then look at the rental forecast over the next 5 years, the same as Birmingham, 19.3%, but from a capital value perspective, sorry, wrong way around. From a house price perspective, we're looking at 19.3%, which was slightly more than Birmingham. But from a rental growth perspective, we're about 10% higher than Birmingham at 21.6%. Okay. Again, these aren't figures that James and I have made up. These are from the likes of JLL that they've forecasted, large global companies throughout the UK. So again, who Salboy are, long-time developer partner of API. Like I said, this completes in 12 months' time, June of next year. Total of 177 units, 250-year leasehold. Service charge slightly higher than the other two developments. However, the amenities and the spec is significantly higher, which you can see in the bottom left-hand picture. Yields, we're looking at about 5.5%, which is extremely attractive. Again, building warranty comes with a 10-year structural warranty, both interior and exterior. So if anything goes wrong as an investor, you're not paying out of your own pocket. And as always, furniture packs are available, which will drive the increase in the rent up, which will then, again, will attract a higher level of income. So just to give you an insight as to where we are, Manchester city centre, and this is where Victoria House is based, okay? Right in New Islington, right next to Piccadilly train line. If we look at the major employment hub along Spinningfields and Deansgate, we're a hugely popular location where all your big corporates want to be based. We're such a short commute, whether that be walking distance or, like I mentioned, via that tram line that takes you throughout the city. Okay, you've got a number of different stops that you can see. If you want to go north towards the Northern Quarterway, or if you want to go south into Deansgate and then into Trafford or Salford Quays. Again, major employers that we spoke about, certainly in Salford Quays, the BBC, the ITV, Ericsson, Bupa, the media hub of the UK. If we look more central, your Amazons, your Googles, Deloitte, your HSBCs, your PwCs. These are the big companies that we want to be looking at. And again, it's not just API or Toni that said, let's go and look at these locations. We also look at the due diligence and research that these companies have conducted as to why they want to relocate their offices there as well. And when they look at the same macroeconomic fundamentals that we do, one, the cost of living significantly less, which means you can pay slightly more because you're cutting costs down, and attract a top level tier of talent. So again, the compelling investment case for Manchester, it is one of the best, very similar to Birmingham. But again, if you want to look at that lower end price point, Derby, albeit it is slightly lower forecasted capital growth, you were talking 1.5–2% less over that 5-year period. It just allows you to transact easier and at a lower amount. But again, with this development being off plan 12 months, this one's 25% down. So, you know, we're looking at a £330,000 entry price point. So with legals, you're in for around the £75,000 to £80,000 mark initially. So that's really it for us today. I hope it was insightful. I hope it was quite educational and not sales focused per se. Like I mentioned, we've got a number of developments within our portfolio across different cities. This was just an overview and insight as to what we have on offer in the different regions.
Yeah, Lewis, thank you so much for all the insights, and James as well. I think one of the biggest things which links us to the teamwork and what our clients are looking for is really looking the best opportunity for the best value that's going to give the really the best return, capital growth, the least risk, and that's what we want to be involved in. And I mean, the properties and the projects that you guys are involved in, like I said, we're really honored to be able to show that to our clients. Just a question for the guys and girls that are still on. If someone is interested in purchasing that property, what is it's a reservation agreement, a deposit. When most of the projects that we're looking at is within 12 months. So just, I mean, the process is pretty simple. If you can just run that through briefly.
Sure. So we've got an initial reservation fee of £5,000. On the Salvo one in Manchester, it's actually £2,000, but typically it's a £5,000 reservation fee. If it's an off-plan development, you would then exchange contracts, which, if it's regional cities, is 20% within 28 days, minus the £5,000 you've already paid. If it's London, it's 10% down, minus the £5,000 you've already paid. And if it's the Salvo project, Victoria House, it's 25% down, minus the £2,000 you've already paid. And then on completion, you would then pay the remainder, of which, again, we would typically mortgage around 70% of that.
Perfect. And then with regarding to South Africans getting a mortgage, is it the same routine? Is there, you know, a lot of my international clients normally recommend to go around 50 to 60% rather than going higher. Do they look at UK citizens differently to South Africans? Would South African pay a higher interest rate because they're South African, or is it your team would look at the best rate with all the different lenders out there?
Yeah, correct. So like I said, we've got a panel of mortgage brokers who have typically around 80 lenders they can use. So I'll have different circumstances and criteria to you or to James. It purely depends on that individual, sort of what their employment is. Are they employed full-time, earnings, risk of their occupation, so on and so forth. But typically what we're seeing for South Africa at the moment is around the 70% loan to value, so 30% deposit. From an investor perspective, ideally we want the investors to put down as little as possible, because it means you achieve your ROI easier. And then you can also spread that across a number of different properties. But one thing that we do, and it's free of charge, is that you can chat to our mortgage team and get what's called a decision in principle. So they will evaluate your circumstances, ask you a couple of questions. They'll then be able to go, right, we can get you a mortgage of X with an interest rate of Y. I think the great thing about off-plan property is that you don't start your mortgage today, you start your mortgage on completion.
Oh, that's amazing, because you're getting the growth, you're getting the capital growth, and you're only taking the full risk once you take.
Correct. So you lock in the purchase price now. Typically, the cities we target will grow 4.5–5% per annum. So if it's a 2-year build, you've put 20% down, but you've made 10%. So it's a 50% ROI over the build period, as an example.
Fantastic, guys. Well, listen, I really want to thank you guys for your time. I know that there was a few people that had to log off. This was recorded, so all our clients that were registered, we had over 25 people that registered for today's webinar. A few people gave their apologies, so we'll send that recording to them, and we'll have a one-on-one with our clients. And if there's further questions, we can have a one-on-one with you, gents, and to lock down the opportunities. But I really thank you for your time and unlocking the potential for our clients in South Africa and all over the world. Thank you, guys.
Perfect. Thank you very much. Appreciate it.
Thank you, guys.
Thank you for everyone joining us today. I will send you the recording by the end of today with the profiles of the properties that Lewis and James have showed, and we will have a one.